So the next hour or so is going to be focused on one of those perils that everybody talks about regarding ILS, and when is it going to make the big time, and when are we going to see oodles of billions of dollars worth of cyber risk transferred to the capital markets. So to take us through one of the key factors in that, the risk modelling side of things, we've got Matt Harrison from RMS, who's going to give us a sort of brief overview, keynote of the readiness of cyber models for cat bonds, after which we'll go straight into a cyber-focused panel as well. So Matt, over to you.
Thanks. As I said, obviously I'm from RMS. I'm going to try and keep this as vendor agnostic, but obviously RMS is what I know best. So if it's a slight bias, it's kind of inevitable in a way. So really I thought I'd start off with talking about where is the modelling, where has it got to, where's it been? As Steve said, this is almost like the starter before the main course. I'm going to try and rip through this quite quickly and just sort of fill in the blanks. Cyber cat models, they're probably about 7 years old. There's various of us in the space right now, but I think what's kind of interesting to see is the rate of change. There have been almost one large annual update per model each year as we kind of learn and understand the peril better. The early things out there were scenarios. It was very deterministic. We've seen the evolution from kind of deterministic models just to try to shape and size the risk, kind of semi-probabilistic, so bad representations of how frequency and severity might occur, just to, again, get that feel for it, moving into kind of the full probabilistic landscape that we're in today. I'd say even with the large annual updates, at RMS we're on V6, and even then there's sort of our point upgrades are probably almost as notable as major upgrades in the other perils that we have. I think it's key that we're starting to see stability though. There's still a lot of change, but as an industry we're starting to kind of coalesce on how we think about it. Probably the main thing is throughout the main models out there that we see, there's almost kind of an agreement on what the core perils are. When we start talking about cyber, there's a big difference between what even is cyber. And I think, for the most, we're talking about the lens of the cyber insurance market predominantly. But within that, we've seen, people talking about 10s, 20s of different scenarios that could emerge. But we've coalesced really on kind of three main perils that we tend to communicate and talk about. So we've got this kind of, I've got a laser pen, so I have to use it because it's just too cool not to. We've got kind of ransomware, there's cloud outage, and then data breach being the kind of the main things that we think about. And even now we try and probably say that really there's a thematic way of grouping these perils together. I mean, this is kind of my language, I suppose, but we've got on the left-hand side what I might think of as like network perils. So, if we think about cyber being attacks against corporates and their digital infrastructure, we've got kind of network perils where the corporates themselves in some way are being hit themselves versus kind of an infrastructure where digital infrastructure is being targeted and the knock-on impact of that is big. Here I'd sort of think about cloud outage. Trying to kind of frame it maybe, and certainly in how I would think of it in the terrible NatCat analogy, I tend to think of sort of ransomware and malware as almost being comparable to hurricane risk. This is frequency and severity. It's the risk that the near misses that we see more frequently. It's the things that almost make headline news. Cloud outage always strikes me as more like an earthquake, if not like Pacific Northwest. When it happens, it's going to be pretty bad, but the frequency is really low. The real tail, the far tail beyond maybe the 1 in 1,000, that's a big scary thing. But up until then, I'm not too concerned. Data breach, I spent all morning thinking of a terrible analogy and I can't think of one. When we think about cyber risk, there's a problem between, is it a first party risk? Is it physical damage? Is it business interruption? Or is it liability? And when we're thinking about data breach, this is the mass theft of data. Really, the losses only get big when we're talking about the liability, when people sue people because of that loss of liability. But for liability, you have to have fault. So if lots of people have their data stolen from lots of places all at the same time, it's hard to argue fault. So we kind of really struggle to see that as being a big scary event. But I think though the kind of though there's a difference potentially between the model vendors on the importance of these, there has been a massive harmony, and this is the kind of main risks. There are other perils out there. There are other things that we model. You know, we look at things like business email compromise, which is like fake president fraud. It's an interesting risk. It's just not a catastrophe peril. It's just not going to cause those big losses. DDoS, there is staggering amounts of data on DDoS attacks. There's just never been an insurable loss because they just don't have the capacity to cause that much harm and damage. So though there's all these crazy things that could happen in cyber, we can kind of reduce it down to probably 3 groups of things that we can really say, this is the risk that we're going to worry about. If we think about the latest advances, so where have, you know, it's probably making it sound over the top and calling it latest advances, but where are we thinking about, and how do we think about models? You know, we've kind of said that we can split the world into different perils, so we have to have different approaches to model those different perils, and we've got to think about them and how we calibrate those differently. I think the key one is the kind of cautious use of history. When we first saw kind of, you know, I've been at RMS sort of 2 and a bit years. Before that, I was at Hiscox for a lifetime, and have been looking at sort of specialty risks and cyber for almost a decade now. So I've seen lots of my competitors and know what they do, but the very, very early models here, often they use kind of statistical basis for making their models. And I think we as an industry just looked at them and were like, what are you talking about? Cyber's a kind of an evolving risk. How are we going to use statistics to build big cat events when we haven't had the big cat events? We don't have this hundreds of years of history, and the risk keeps changing. It's useful to kind of think about, you know, the 1 in 20, 1 in 30 type problem, but beyond that, history becomes sort of less relevant. But it's still a great piece to kind of mine to understand how losses occur. You know, what's the cost look like? We've got cyber attacks happening. We've probably almost got, people talk about cyber and the deficit of data. It's almost the other way around. There's like an excess of data. It's just figuring out how to use it properly. We're getting claims all the time, so being able to calibrate costs isn't that difficult. But how do we build models? One thing that I always think, you know, where the evolution here is, certainly I think at RMS, my colleagues at RMS probably get upset when I say this, but I think in some ways we have to be more sophisticated than the NatCat models. NatCat models have a history of being able to use statistics, thinking about hurricane frequency. We've got years of hurricanes. But if we didn't have that, and how we think about climate change, we have to think about how do we understand the physics of the system? How do we build, you know, in NatCat, we're moving to a world of things like global climate models. Build a model, a representation of the world, and then see how, when you change that world, how do hurricane rates change? How do other perils change and emerge? So, you know, one of the big things I think that's happened in cyber is when we all started on this, you didn't really know how the system worked. Why do threat actors do what they do? How do vulnerabilities occur? How do corporates use software? And over the last kind of 7 years, there's been a real evolution in our understanding of that. So we can now get to this point where we can model the system. We can build objective ways where we don't come with a predetermined view of what the risk looks like. We have an objective way of formulating how the risk evolves and what catastrophe risk looks like. I'm going to pivot away. As I said, I'm trying to do this as the preamble to the debate. So I think, you know, what are the dynamics that we're seeing? The insurance industry is still growing at pace and has a good reason to. You know, we see that there barely goes a corporate risk register that you ever hear about where cyber's not like in the top 3 risk. Corporates are dying out for risk transfer here. So the demand is huge. We've had like 2020 when the risk was priced completely wrong, and you know the insurance industry started to lose money. Well, that's completely swung round. We've had a massive injection of rate, and ultimately, I think the appeal from the insurance and reinsurance industry is there's just a need for more capital to get behind this. You've got, in some way, there is diversification within cyber portfolios, but ultimately everybody uses technology. You know, show me a corporation that doesn't, in some part of its business chain, use the Windows operating system. You know, we're getting kind of more and more people using the cloud, but there's only 3 main cloud providers out there. So we don't have this kind of huge diversification of cyber perils. But that just means that there's more need for capital to support the tail risk that's out there. And with that, we just expect it to come at a price. There's a need for that capacity. So there's going to be a need to pay for that capacity. So I mean, as far as we're concerned, the prices just have to be there to pay for that whether it's alternative or reinsurance capacity. The need is just so high. And then I think, you know, one of the things where models have been working on, we've been doing a lot of work, and obviously, you know, Moody's being the new RMS owner, where there's a kind of a double interest, and I think some of our competitors have been thinking about this as well, as thinking more broadly about cyber as an asset class. You know, is cyber a systemic investment risk? So, you know, we years ago we built an IED. We did that by building what we called an EED. So trying to understand what the corporate world looks like, and then we can overlay insurance penetration rates, take up limits, deductibles on that. So we can kind of model cyber from an insurance perspective, but we can try and model cyber as an economic perspective. We've also done some work with Moody's, which I'm hoping will be published soon, where they're looking at the kind of the Moody's rated universe. So if we look at all the corporates within the Moody's rated universe and we apply catastrophe models, what's the impact of that? Broadly, those, you know, there's often like peak revenue loss, but there's the profit loss where the actual impact on the balance sheet of corporates is, yeah, it's in the billions, but it's not in the trillions. So we're seeing this as, from an investment perspective to a normal investment portfolio, we're expecting cyber to probably cause chaos for days following a big catastrophe event. But it's not eroding capacity and capital in a way that it has a systemic issue to the investment industry. So there is sort of, it isn't the kind of, investors aren't going to be looking at cyber going, Jesus, I'm full. I don't want to be more exposed to cyber, because it's not going to systemically erode capital. And probably my last slide is sort of talking about the readiness of models, trying to summarize this, I suppose. Really, you know, I think we see it in a point where the model started off as being very expert judgment driven. And the problem with expert judgment, as we know, is like, you know, my expert judge is bigger than your expert judge. You know, where is the objectivity? Well, that's just diminishing at a frightening rate of knots. You know, the models are, of course there's expert judgment. There's expert judgment in Nat Cat models. I think in cyber we're getting to the point where we're almost at a comparable level. So we're just seeing the reliance on expert judgment being far, far less in how we build those models. There's a consensus on what the perils are. What should we be worried about? And then we're also seeing this kind of, the feedback loops really starting. You know, people are, you know, the insurers, the reinsurers, they're licensing the models more. They might not be deploying them 100% out the box at scale, but there's the questioning, there's the feedback loop, there's the evolution together. And then more broadly, there's just a kind of an industry alignment on the understanding of the peril. And then finally, when we think about things like cat bonds, IEDs, ILCs, that kind of currency that we've become reliant on is becoming available. There's still evolution to happen, but they are fundamental parts of the building blocks right now. I said it was a quick summary, so that was a whistle-stop tour, so I think we're onto the panel. Cool, thanks.
Hurry up, Tom. I'm hurrying. I move my own pace.
Thank you very much, everyone. So this panel is about the potential for cyber cat bonds. So cyber, as Matt just explained, is a fast-growing line of business in the insurance and reinsurance market. And there is a dire need for more capacity. Yet we are not seeing lots of ILS transactions to date. And so I've invited the panelists here today to try to understand what we can do to improve the situation and hopefully create a new chapter in the next edition of that book, where it's going to talk about cyber cat bonds. So we have Tom, the head of PCS, here in the center. And then to the very right, we have Raf, portfolio manager at Securities. And then obviously Matt from RMS. So maybe I will start with Tom. And Tom, what is the pulse of the ILS investors on the topic of cyber insurance?
The pulse is more like an erratic heartbeat. You know, there are pockets of interest. I mean, we conducted our own research, which we didn't print in such fine form, and have found 7 ILS funds have already deployed to cyber. And there's a widespread within that as well. You've got a couple who have gone in heavy, and then at the other end of the spectrum, you have a few who have dabbled or, you know, taken them as part of broader deals. So it's happening. There is no consensus, and then there are folks on the sidelines as well. We're aware of probably another 7 or 8 on top of the initial 7 who have deployed, who have, again, taken an interest, done some analysis, but haven't drawn any conclusions yet. Some want industry loss, some won't touch industry loss. Some are hungry to deploy on parametric without regard to what a buyer wants. The one thing I do find fairly consistent across the ILS industry is frustration with the expectations of protection buyers who think it's still 2016. Yeah, we can get everything we want in a low single-digit, uncapped quota share, and we expect to be thanked for the opportunity for you to buy. Yeah, tell me when I'm wrong, Matt.
No, I couldn't agree more.
So, Raf, what do you feel about that statement, actually?
I think people are definitely trying. I think where I had seen, so I focus on cat bonds. I'll try, my statements will all have a cat bond bias, but where I saw probably a peak of pre-marketing activity was about 2 years ago. And people were definitely trying. I think there was a sort of a consensus emerging in the market that in the early days of trying to get something done, you sort of have to think back to the early days of the cat bond market, right? Keep, you know, pre-marketing periods are probably going to be quite long. For most of the cat bond markets, you know, we license cat models. We don't tend to license the cyber models, so people are going to take some time to understand how these models operate, and you know, a lot of people will do deep dives. I think where things probably broke down is similar to what Tom said, is there was a large mismatch in, you know, what investors wanted to take on, like us, and perhaps what cedents were willing to pay for it, or to have, you know, certain structures. Things maybe have changed, you could argue, have changed in the last 2 years, given the performance of the industry, but I'm still not seeing that transition happen. One of the arrangers put it to me in that they were still looking for that committed sponsor of cat bonds, maybe similar to Alan Punter said, USAA, you know, someone similar to that to take the first steps to advance the market. From our perspective, you know, we would invest in cyber. We don't have any exclusions that I can think of in our portfolios to not take cyber. The key point, which sort of Matt touched upon in his prior slide, is that, you know, for us, we're a diversifying investment to our investors, and can we maintain that conviction that, you know, a cyber investment is diversifying? I thought an interesting point is maybe when people invested in the PEF deal back in 2017, I don't think people would have thought about the correlation of the PEF, which was a pandemic bond, to, you know, global markets, to capital markets, and clearly there was a very large correlation, right? So I don't know that you can always state with certainty, right, what that correlation is going to look like, and that's just something that will come into the analysis. So if we think there is a correlation, that doesn't mean we can't invest in it. That just, you know, that just allows us to size an investment appropriately. The final thing maybe to state is one of the benefits of an ILS investment is you get paid specifically for the risk you're taking on, as opposed to, you know, maybe equity investors who are taking on that cyber risk without getting compensated for it. So that's the argument that, you know, most ILS investors would make there.
Actually, so Matt, from that standpoint, do you think that the cyber modeling techniques can be used for cat bonds today, which are obviously a requirement for investors like Raf?
Yeah, I mean, I have no problem with with why it wouldn't. I think we're at a point of, there's an objectivity, there's a clarity on what we're doing. I think there's, early days of the models, and I'm probably being less talking about RMS, but there was a bit of hand waviness about how the models were made and parameterized. I don't see that anymore. I think there's a clear willingness from the model vendors to communicate what they're doing, where it is, and how to try and align there. I think it's about structuring is probably the bigger issue, what the structure looks like. As Tom says, if it's like uncapped quota share, yeah, we can model it, great. It's just who's going to want to invest in it.
When's the last time you saw an all-peril cat bond? Yet that is the demand of sponsors in the cyberspace. I think, if you're looking at something that's high up, you've got to get realistic about the perils that'll get you there. And honestly, how many cyber perils would be relevant to like a $3 or $4 billion affirmative strike? Probably not many. So you're naturally going to wind up with less coverage up there anyway. You just have to make the affirmative statement that, yes, okay, we're going to narrow it down to 4 or 5 or 6. We're going to model them, well, or at least as well as can be, which is still pretty good. And we can move forward on that basis. But right now, everyone is so worked up over fear of the unknown, which I get, that they're not willing to take a common sense approach to how much the unknown narrows as you get further up the industry loss kind of ladder.
I think it's been the problem of a kind of a relatively small industry to start with. The smaller the industry, the more kind of shock losses produce that volatility. If it was only a $3 billion premium industry and people are buying a $750 million tower, that just a shock, what most of us would call a large risk loss. In the cyber industry almost gets think of as being a catastrophe loss. That's not a catastrophe loss. If you can't cover that, what are you doing?
The largest affirmative cyber loss we've got is Capital One, which is bigger than the affirmative cyber loss from NotPetya, which itself was a cat. And, where else do you see that? I mean, it's a small, thinly penetrated, kind of unevenly distributed market. I mean, we're working on our own IED right now. And I'm still stunned by how twisted things are in the large tower space versus kind of 99 million in limit and down, where it looks really odd. On the other hand, if you tweak your assumptions and say, okay, $4 billion affirmative cyber cat means 50 or 60 is going to basically be an ag of large towers from the same underlying loss. Okay, that's sensible, you can model it. Also, probably aligns with your portfolio. So you're now thinking in terms of the risk and in terms of your book, which you probably should be doing anyway if you're going to pay to transfer risk.
So, look, I think what you are saying is that we need to, so today the cedants have probably unrealistic expectations as to what the market can offer. We can all hope that in time, because they are going to grow their exposure and the need for reinsurance is going to increase at some point, they'll have to switch more to what the investors want to invest in. So can we try to focus on more precisely, if today we were to show a cyber bond, what would it need to look like for you guys to invest in it? And maybe, first of all, does it need to be non-indemnity? What about the flexibility around indemnity? How would you feel about this, Raf?
Remember who you're sitting next to.
Yeah, definitely. I think from our perspective, what a lot of it is not just about the reporting agent. It's how we feel like there is this ability to model that industry. I think from my perspective, and I might be totally wrong here, most CAT models develop to model portfolios or risks initially before taking that step to model the industry. And there's a subtle, not subtle, there's an important difference, because then you've got to quantify, and I think, again, like I think Matt touched upon this, you've got to figure out how that industry structure works, right? And at least from what I've seen initially, that wasn't quite where the focus was. So that's, maybe a potential obstacle to non-indemnity deals. At the same time, it you know, there are issues with indemnity deals, right? Is there just the infrastructure? And the other thing, you know, which again mimics what you guys are saying, what I observe is just the infrastructure in the cyber market isn't quite there to allow for a cat bond transaction. You know, the barrier to get a cat bond over the line is pretty enormous, right? If you think about what was happening in the property market when cat bonds were issued, we were a long way more perhaps advanced than, you know, the state of the cyber market now, just in terms of what the infrastructure available in the market is. And I don't mean, you know, technological infrastructure, because clearly that's going to be there, but I just mean the, you know, the ability to understand what these cyber policies are covering. You know, we have guys at Securities who focus a lot on cyber. They've been doing that for the last 6 years completely unsuccessfully because they've not got a deal over the line. But the last deal they showed me some pretty stark, you know, some pretty concerning lack of data that carriers have on what they're covering. And if you think about the current state of the cat bond market, you know, people don't touch bonds if you don't, you know entirely what you're covering, or, you know, where 99.9% of your risks are, say, in the U.S.
And this is where I'd like to see it broked a little bit better. To Matt's point earlier, there's a lot of data on cyber out there. What there's not a lot of is insurance data in the form of policy and insured loss, which I know is the currency of the realm, right? So you wind up with that additional step of having to proxy your way over to insured loss from economic loss, from attack and threat data. And there's threat and attack data in abundance. I mean, I struggle to believe we can't find a hot actuary out there who can't bridge the gap credibly. But if you've got someone smart, are you going to put them on that, or are you going to put them on Florida wind, or, you know, Cal quake, or something else that's making money right now? I get it, but you know, the reality is, if you look at NotPetya, which had $10 billion economic loss, 3 and change insured, probably $4.5 billion in economic that we know on a named basis, in addition to sandworm cruise behavior and the threat environment, and on and on and on, you can form a view of the risk. It's just not the exact same form of a view of the risk that we're accustomed to by looking at industry-wide insured loss. You know, unfortunately, yeah, that's a stumbling block, but I think you could figure that out in your spare time. I mean,
That's what we do.
yeah, exactly. I mean, rather well.
But in a way, you are touching another point, which is the structural strengths of the bond. If you have issues defining exactly how the event would work and what policies are covered, and doesn't that call for some parametric or PCS deals where probably that's easier to define and there is less hazard as to what would happen post-event?
Yeah, I think so, and not out of self-interest. I genuinely, I mean, trust me, I'm the last honest reporting agent. No, I genuinely believe it. I think parametric is difficult because, all right, you can use it for a top layer RDS type relief, which sounds really good, but they're generally structured to attach well above the R in RDS, and they don't necessarily map to the real significant threats you face every day. I mean, I hear cloud outage all the time, and I'm tired of it. You know, if the cloud goes down, it's a free-for-all, guys. You know, don't look for me, you don't want to find me, because society will be collapsing if we see that kind of attack, right?
But it doesn't affect the investment markets, I thought.
Well, no, at that bit, well, you got to remember, it's such a severe remote risk that it falls under everything correlating in the tail.
Yeah, but I just heard that it doesn't affect investment portfolios.
I don't think it gets. I mean, I think it's
Multiple clouds going down for
I
2
think-
weeks at a time?
I mean, if that happens,
Yeah, again,
maybe.
canned goods and ammunition.
But I think it's
That's what you want.
maybe an axe.
Yes, oh, you're good, yeah.
But you know, that I think some of the problems is like, you know, those questions are like, what, you know, the analogy is like, well, what happens if 7 magnitude 9 earthquakes happen tomorrow? What happens if 20 Cat 5 hurricanes make landfall in the US tomorrow? Like those, there's a difference between, you know, there's the risks that we worry about, and are they, you know, as you say, realistic? If we're talking about a 1 in 10,000, a 1 in 200,000, fine. But I think some of these events are so far out in the tail, but it's because we're not because it's a new emerging risk,
Yeah.
you don't have that natural kind of.
And that's the problem. These parametrics are hedging or purport to hedge or address the 25 Cat 5s hitting the Gulf within a week of each other. Nobody cares. I mean, if you do an ILW on a 1x 3 billion strike or a 4 billion binary, I mean, those are already pretty remote events. Those are insurance portfolio scary events, but they don't signal the downfall of society, and I would call them at kind of the upper end of addressable realistic.
But Tom, excuse me, but we could find a cloud outage trigger that wouldn't be so far that it would still be realistic. Matt, what do you think?
I think the difficulty for me is more. I'm parametric skeptical. I spent years thinking about this and how would one do it. I'm a geek. I'm quite happy with that. To me, it's more. We're used to parametric products where the reporting agency is kind of objective and neutral. Well, and they're kind of often governmental. So you're like, yeah, we know that we can almost trust this, right? Or there are reporting stations. I just worry that if you're looking at cloud outage, the main person to know that AWS is down is AWS themselves.
Certainly. I mean, everybody knows that AWS is down because everybody tries to get on the. I mean, if there's something that is easily.
It can be more nuanced than that.
But the difficulty there is, that the insurance cover is typically for is typically based on a harmful act, whereas who is going to say that this was a harmful act? I think I can get that we can say
we would. I mean,
this
you
is.
would have us front to parametric.
I mean, moral hazard is obviously an issue in insurance, right? So
Yeah.
I don't quite see how, if I invest in an indemnity deal, where I, again, am getting the loss data from the guy I'm covering, how maybe that might be any different. I think there are third parties out there as well who can, again, this is all beyond me because I'm not a network engineer, right? But who can ping the servers and get that information, right?
There's that. The more fundamental issue isn't moral hazard or reporting. So I mean, we've been the reporting agent on some parametrics, and that can work. The issue is really just the workability of the solution. So for stuff like outage, a lot of policies have the 5, 6, 8 day waiting period, right? Now, the main characteristic of cyber compared to kinetic attacks is reversibility. My favorite example, such as one can have a favorite with this kind of thing, is comparing the Colonial Pipeline cyber attack to the kinetic attack on Kramatorsk in Kramatorsk, Ukraine. All right, Colonial Pipeline got hit, strategic energy asset in the United States. 5 days later, it was back up and running. 6 days later, every driver with the memory of a goldfish forgot the whole thing happened. Right? It did not change society. 5 days, back. Amazon would probably be back faster than that.
Yeah.
Kramatorsk got hit by actual bombs. It's likely to be down for years, because it's going to be months after any sort of ceasefire that you can even get adjusters in there. And we're not talking about the supply chain for materials for wind farms, even in that context, right? So when you're looking at an 8 day waiting period before insurance even kicks in on some of these major losses, that solves a lot of problems regarding the threat of outage. So you have to attach it way up in the gods, because anything below that wouldn't even trigger. I mean, debatability, but we're talking debatability at a remote level to begin with.
I mean, the attachment's a little bit lower, but I mean, I certainly don't think. So I agree with about the reversibility. I think we're as an industry, I think we're more thinking it's 2, 3, beyond 2, 3 days. We're getting to the realms of how the hell would that actually happen?
Yeah.
So I don't think that's as significant risk.
2 to 3 days, even for a sophisticated target. Colonial Pipeline, not a sophisticated target, and they were back in 5. If you're talking a Google or a Microsoft, I mean, 5 days is a long time, and not only are their waiting periods long, their SIRs on their policy are massive as well. I mean, we know several of these big tech players who have 9-figure SIRs sitting under their policies. So you think about it, a whole lot has to go wrong before the insurance industry even, feels a pinch.
Okay, that doesn't help Raf's problem of how the hell can he buy a
I mean,
cyber
the insurance
cat bond?
industry
ECS,
is,
man, I've been telling you for years.
yeah.
Problem solved.
But you're saying there are no outage claims, right? Because the insurance industry has such high deductibles. I mean,
Well,
they have been paying claims, right, on outage. I do think parametric is likely, a solution that can get the industry over the line on one of the first few deals. If that happens, you guys can waive your license fees for Securities for an entire year, right? But
I'm almost inclined to take that bet.
I mean, the issue is that the control's in my hand, right? I'm the guy who invested in the deal. I think, parametric is one of the solutions. I'm sure there are, what we see is that there's a lot of different types of deals that come to market from where we sit. What are the most optimistic ones seem to be parametric because we can, isolate it to very specific events. The Cat 1 market likes certainty and specificity. So that's why it works there, right? Which is not quite in line, perhaps, with an insurance buyer, but you can see how, as you go further up that, that value chain, that can work for certain buyers.
It's because, Tom, it's not about what the cedant wants; it's about what the investors can accommodate at this stage.
In a hard market, that is objectively true. But on the other hand, though, you've got buyers who don't realize the market's that hard, which is why these aren't getting over the goal line. You look at it and think, yes, this is what they should be doing. And then you step back and are like, okay, why aren't they getting done? And I generally believe it's buyer expectations. We're still seeing stuff marketed, or you talk about the pre-marketing cycle. The stuff that's in there is a bit divorced from reality. You've got all peril stuff coming through. You've got cedant defining event, which, come on, right? I mean, they want to make the rules. They also want to call the plays during the game. So the only circumstances under which, you would be able to protect your position would be in the most extreme loss-free environment. And what's tough right now is if you look at, cedant advanced definitions, some of it's nuts. And some of it would expose you to unexpected risk.
Tom, I think let's have the discussion after the 1/1 renewal when they realize they don't necessarily have all the capacity they want because they keep growing. So every year it's becoming a more acute problem. But I'd like to go back to the point on parametric because at the end of the day, let's say the cedant has not found enough traditional capacity and they're like, okay, what do I do? And then we're like, maybe you should do a parametric cat bond or a PCS cat bond. So Matt, from your standpoint, are you able to demonstrate to a cedant the value of these covers? Because ultimately it's mapping within RMS or a model, the difference between their indemnity losses and the recovery from the trigger. Is that something you would feel comfortable with now?
Yeah, certainly from the PCS side, I think, we've spent a lot of time. We've had an IED for getting on for 3 years. And we're constantly thinking about how do we ingest more data to try and make that more representative. I mean, obviously, we're seeing, it depends on the cedant, right? If you've got a very specific, if the sponsor has a very specific book of business, it's not going to marry well to an IED. It never does. It wouldn't in a nat cat risk if you're only writing Floridian specific and you're looking at a full Atlantic hurricane, it's a subset of the risk. But as long as we're seeing somebody with a representative view of the risk, we think that's a perfectly doable transaction from the modelling and understanding the risk and the peril. Parametric, we think you can do it. It's just I have a lot of concerns on the observability and the kind of the basis risk on the observing agency. That's the problem I have, not the modelling of it.
So let's go back on the IED, because on the NatCat side, IED has been a key topic recently for PCS deals, not so much because of PCS, but because of the issues around how old the IED was and how with inflation, how the mismatch between both. How do you think, in the cyber world, do you think the IED is modeled accurately to reflect the true exposure? Because it's one thing to know where a building is in front of Miami Beach and then there is a hurricane, it's destroyed. But in cyber, how can you determine what the ID really is? And how can you make sure that post-event it's going to work in line with your initial assumptions?
I mean, I think there's always a difficulty when we're thinking here about how specific do we need to be? You know, are we talking about, are we going to have to name and shame an individual company within the, you know, if we're thinking about cyber as being a corporate risk rather than a property risk, as soon as we're like optimizing to the level of thinking about a single corporate, the uncertainty just isn't going to hold, right? But once we're thinking about a reasonably sized market with a reasonably high attachment rate, those uncertainties kind of come out in the wash. You know, that isn't a problem. I think, you know, as we said, we've thought about it by trying to understand the economy to start with and then overlaying take-up rates and how much insurance is purchased. And then we can get other sources to kind of back validate that is representative of who's buying what.
And have you done that in line with PCS so that the two match?
Oh, absolutely. And I think the one thing I would add is what we've found in our exposure work, which has been extensive and years long, is that the limits on a lot of these insurance programs are fairly low compared to property counterparts. So even though there's some uncertainty around who gets hit and to what extent matters less because the prospect of a limits loss is higher, right? If you've got 100 million in limit, you get hit by a $20 million ransomware demand, you're really looking at a limits loss, right? Because you've got your 20 million in ransom, you got PR, IR, crisis, you got your lawyers, IT forensics, none of which is cheap. And then you've also got like your actual work in the data center to get done, right? So we've seen, I think of our largest losses that we've tracked, the stuff called X50 or X100, the overwhelming majority have been totaled. You know, even something like Cap 1, which was floating around 150 on a 400 to start, once the third party came in, you know, you kind of knew it was toast. So if you look at a large cyber cat, right, affirmative cyber cat, you know, a 3 or a 4 bill, you know, my gut on this is at least half of that's got to come from the X100 stuff, which is pretty easy to quantify and know. We've got a good handle on that by name. All right, you figure, okay, you've got this basket of known companies that have big cover. How many of these guys get hit and smoked? You know, you model out the likelihood that some of them get on a partial, but that's going to be a smaller percentage than it would for prop cat. And then you figure the SME stuff's probably going to get largely totaled as well, because those are small limits that get hit hard. All right, that's a lot easier than cat. I mean, to my simple mind.
You know, yeah, we definitely think that the SME is important, but it's not.
It's not driver.
It's not the driver. It's kind of a rounding out, not a rounding out. That's doing a disservice. But it's not Nat Cat where you're looking at millions of structures, right? It's the loss is driven by the big corporates. So the more we understand that, that's not the totality of the risk, but it's the material driver of the risk.
I'd say there are about 700-800 companies in the world that you need to lose sleep over when you're thinking about a multi-billion-dollar affirmative cyber cat, because they all account for a half to 2/3 of the loss. And some of them, you know, are actually less daunting than you think because you got the big SIRs sitting underneath them. So if a major player like an Amazon, like an Alphabet, gets hit badly enough that you care, if it's big enough to clear that SIR, it's probably big enough to go the distance, at least, you know, proportionate to commensurate property losses. So to me, it really simplifies the process. Also cuts the tail on loss development. So, you know, if you're worried about a earthquake or terror-sized extension period on an instrument, I don't think you have to worry as hard about that for big cyber cat. You know, it's one of those things where you know it when you see it.
Well, I think that's been the problem, hasn't it? Like, you know, there's been a desire to put quota share in to make it easy for the buyer to start with, and that does have that kind of reserve risk element to it. But when you're looking at the cyber cat, it's more first party. Yeah. The amount of third party risk in there is just so small. You've been attacked. You're not at fault.
And not to mention, like, how many big cyber losses, even on the breach side, have you seen where third party even comes in? Limits are so low that Marriott was,
Marriott was the big one.
yeah, Cap One was the first where I think third party really influenced the laws. I think Marriott might have been first party for big. Oh yeah, we could go either way on that one.
There's,
But take Equifax though, $125 million tower. Everyone knew it was like $1 billion economic loss from day one. If you're doing an index type trade, great. It's dead and buried from the minute you wake up. But if you're doing a quota share, it's going to take 2 years for someone with a clipboard to show up. So you're going to spend a lot of money basically reinforcing the obvious through that loss reserve process.
But it still affects the excess of loss, right? Like, I don't think you can make the same arguments for events we've seen in the last few years. And it still affects the, I mean, you just have to look at, on the excess of loss book, some of the reserving, some of the claims triangles, and they take about, even the 2020 claims still haven't developed on those books yet.
It'll take a while. But the quantum on those is probably knowable and manageable, on a projected basis. But because you're on an XOL account, you've got to wait for this stuff to develop. Even if you can think the obvious, there's a certain form and process to claim adjusting, as there should be. And that means that you're going to bear expense through the entirety of it, which is probably the most massive frictional cost in cyber cat bonds, and probably in UNL cat bonds too, that nobody talks about.
So I'd like to spend a bit of time on the legal format of the instrument, because we don't have that much before the questions. Raf, 1448 cat bond or private bond, does it matter? Do you want to be in a pool deal, a large pool of investors?
I guess initially it doesn't matter, right? If it's going to be a small niche part of the ILS market, it probably doesn't matter much. The type of capacity one could bring to the table will hinge on whether it is, a collateralized re-deal or a 4.2 deal or a 144A deal. So if it's always going to be a small part of the market, it doesn't matter. If there were a future where cyber is going to be bigger than that, that's probably where it will start to matter more. Initially, what we would like to see is syndicated deals. Bilateral deals are great for the more complex stuff. Syndicated deals are good to just get that market consensus over. But the one problem with market sort of consensus is if it's not a very deep market, people like us get hurt on the secondary market. So we might buy, for example, what's happened in Florida last year. One might buy bonds. There's not much depth in that market, and then you get hurt in the secondary market.
Tom, does that is it in line with the survey you conducted?
Generally, yeah. So we heard from a lot of people that they prefer 144A overall. Similar issue, safety in numbers. If it blows up, at least everybody blows up with me. And some notion of liquidity, although I would look even at the 144A market as probably shorter instruments, maybe 12 to 18 months for cyber early on. I don't see people trading, issuing 3-year. And I would guess that on that basis, you've got to look at it as a hold to maturity. I mean, maybe you can trade it out, but I just think that secondary market would be so thin that you've got to be looking at it, for the duration of the instrument. Bilaterals are interesting. So my kind of working theory on the first trade has always been, a 144A attracts a lot of people, consistent with the research, strength in numbers, market consensus. But on the other hand, I don't rule out some ILW broker who can't spell ILW. We all know these guys, right? And they're great. Just grabbing a buyer, grabbing a seller and saying, guys, you need to do one of these cyber things. Let's just go have at it. And having them do it. And we see it all the time in CAT. We don't like to talk about it. I don't rule that out. I think there's some non-cyber broker out there who could probably pull this off and no one would see it coming. You're thinking of names, aren't you? That's why you're laughing.
No, it's just your gung-ho approach always amuses me, that's all.
So going back to the 144A, then obviously it would be a multi-year instrument. Matt, do you think a reset is possible for a PCS cyber deal, or is it like complicated? Should we start with 1-year deal initially, or?
think a 1-year deal makes sense to start with because we're all learning, right? We're pretty comfortable from our side, but I think as a wider industry, we just want to keep it simple, right? And I think keep it 1 year, really prove that it's done and dusted, and then you can see the value in it, and everyone can see the value in it.
Perfect. So look, I think it's pretty clear the brokers have to start pitching the cedant to get them to understand that they are not going to get what they want, but what the investors want. So we are trying to work hard on this. So with this, I'm going to take some questions from the floor, if you have any.
Aloha from Honolulu, Brendan Larson from Absolute Climate, where we write our own climate models. We understand a lot about software. Question, I'm just thinking about the known unknowns, like zero-day exploits, which is part of the cyber risk. How do you model that? And then the other question is, how do you, from a talent perspective, how do you compete with people like Google, like Project Zero, where these guys are, it's not about how many PhDs they have, but it's about the practitioner's experience they have in uncovering zero-day exploits. And then I'll leave you with one other thought. Putin, Russia, there was a lot of thought that here it comes, they're going to cyber attack everyone. Are our defenses better? Is that why it didn't quite happen the way maybe some imagined? Or is Russia not as good? And how do you model that?
If you take 0 day, can I take Putin?
Yeah, thanks.
Whatever works.
Yeah.
I mean, I've got my own opinions, but I'll let you go first. I mean, from the 0 day, I mean, that's a big part of, there's a difference, right, between known unknowns and 0 days. In terms of how we think about the risk. The 0 day is probably, to me, the scariest risk out there, but it's the one that we try to model the hardest because we know about it. There's a difference between, do we know which 0 day is going to occur? Of course we don't. But that's a bit like saying, do we know next year when a Cat 5 is going to make landfall and where is it going to make landfall? We have a probability of understanding its occurrence and its impact. And there's tons of data on there's the National Vulnerability Database. There's tons of data about how often 0 days vulnerabilities occur in the world. There's tons of data about the software market. So to me, that's just a model problem. I have no qualms with that at all. Tom, I'll let you take the next bit, and then I'll.
And also, I wouldn't stop at 1 0 day, right? It's getting to the point where more and more you need to daisy chain multiple 0 days together, and they're expensive. So if you're operating out of the Kremlin, for example, take something like a Russian equivalent to the NSO Symphony hack, right? 7 0 days, plus the talent wrapped around that to develop the tool, you're looking at probably $40–50 million to execute on that. That's a 5th-gen fighter, and which is going to cause more irreversible damage. It ain't 7 0 days. As to the attack environment right now, reversibility is key. So I've heard a lot of people wonder why the Kremlin didn't take out communication towers in Ukraine by cyber, because you'd have to spend $40–50 million on the relevant 0 days to take it out for what, 3 or 4 days before it's back up. Airstrikes, take it down and keep it down, and it's cheaper, it's easier, it's more predictable, and you're not burning a vulnerable tool on it.
I think the other point is if you look at both NotPetya and WannaCry, that 5-year anniversary of the kind of the big cyber attacks, both of them incurred kind of quite significant friendly fire. If you look back, it was NotPetya, so that was a kind of an attack on Ukraine, right?
Yeah.
One of the companies that hit the hardest was Rosneft, which is one of the largest sources of Putin's wealth. So you don't want to carry out an attack where you could be the person who gets hit the hardest by it.
If you can't throw a grenade 25 meters, you don't want to.
Yeah, and I'm not even going to respond. You're just going to trump whatever I say. I'll just leave you to it.
Oh.
I've got my point. I'm done.
The one thing I'd add also is, the Cyrillic keyboard kept them from attacking Ukraine. Your point about Rosneft. What I would also say is, given that cyber's fairly easily reversible, it doesn't make sense during the conflict. My operating theory right now is once you see a ceasefire, you'll probably see an uptick in activity.
Yeah.
You need to be able to repatriate cash. Someone like Conti has hard dollar, hard ruble costs. They have office space in St. Pete's and Moscow. They have an HR department. They have an employee of the month program we learned from the Conti chat leaks. And people have to get paid. So if you've got these independent organizations that may be state aligned and state accommodated, but not state sponsored or funded, well, they need to be able to make money. And if you can't get money back into the country, now's not a good time to fight. But I wouldn't be surprised to see post-conflict, the Kremlin turn around and say to Prigozhin or whoever, you know, hey guys, gloves are off, go attack who you want. We don't care about your targets, we're not directing, so I wouldn't call it state-sponsored. But, you know, there is a political bias there toward Western destabilization, which these ransomware gangs would accomplish. And I think you could probably model that in your sleep.
Yeah. Let's have another question.
So, Tom, you talked a few times about reversibility as being a big factor. And I think implicit in your comments was that where cyber risk is the most expensive, i.e., on a larger scale in the developed world, the resources are more likely to be present to reverse quickly. How do you think about that? What do you think could be a truly long-term, large-scale, developed world cyber loss? Because that's where we have our super cat. Because, you know, just to take that, if you have a large-scale, long-term cyber loss outside of you know, highly developed economies, it could be tragic, it could have consequences, but it's not likely to be massively insured.
Yeah, so it's tough. I think the main issue, and I'm curious on your exposure thoughts on this as well, is the exposures, Mike, aren't there for it to be truly widespread the way you would think of the 90 or $100 billion property cat. I think that if a cyber equivalent of that were to be reached, it would just be a true societal problem to the point where we wouldn't have to worry about insurance quite so much because the economic system would be in really bad shape. So I think it's really tough to strike that balance.
I think we have to be getting there, because I think global cyber premium last year was about $9 billion.
But
so if
exposure's down, though, on that. We have exposure down 10 to 15%.
But if we assume rates online are well under 10%, that implies we do have more than 100 billion. We certainly don't have 100 billion per event, but it's getting there. Well, and we're expecting that to be 25 billion in 2025. So, you know, at 20 times that, you're starting to get to real numbers, $500 billion.
Starting to, but I think it's going to be tough to get to those real numbers. I think it's fits and starts. I think we've got enough volatility on premium and exposure right now that we can't take that straight line trajectory the way we used to. You know, could something happen if you had enough interconnected major infrastructure, probably I would even say disparate sectors getting hit at the same time, but it becomes an increasingly difficult one to achieve.
I think, you know, the scenarios that we can think of, but where they're actually insured is the bit that I'd be more, I don't think they are, probably. I mean, as you said, that the infrastructure problem outside of cloud isn't. If we're looking about, you know, one of the things that people have talked about is almost like the unreliability of data. If you stopped trusting cyber, if you stopped trusting digital assets, you have massive erosion of corporate value, but it's not an insured problem. So that kind of the long-term erosion of cyber in that way, I find this very hard to figure out. And one of the things
that clearly becomes systemic, because you have giant amounts of market cap based on the notion that companies can freely transfer money and information over the web.
Yeah, I mean, so that strikes me as a huge problem. It's just not an insurable problem right now. And I think, you know, one of the things that we tend to see in cyber, that people always talk about what's the next new thing, but for most of cyber, it's kind of cliched that when you talk to people from the cybersecurity industries, usually there aren't new emerging risks. They're just old risks done in a new way. So we don't really have this huge amount of black swan type risk. It's kind of just white swan. You just got to keep your eye on them, right?
Yeah.
It's just, I don't know, a white swan with a haircut or some other terrible cliche. But it's not truly black swan.
Yeah, I think we're seeing around 300 billion in exposure we know about right now, or have estimated, which is non-trivial. But it's also disconnected. And I think some of the contract language underlying the technology licensing agreements is a barrier as well, where if you've got, a software vendor who doesn't allow their clients to claim or sue them or claim against them, that puts something of a limit on the potential insured loss as well. So I think there are some structural issues that may keep losses from accumulating the way they might be able to otherwise.
Thank you. I think we are up against the time if we want to meet the schedule. And there's only one person who left, so I guess the panel was a success, given that it's...
Oh, let's give this guy his last.
I'll just be very quickly. I'm Harvey Wishakoff. I'm from the American Bar Association. The question I have is, in the answer you gave concerning, let's say, solar winds, you made distinction between state versus non-state sponsored. And we also in international law are saying state responsibility. So if these attacks are coming from the state, regardless if it's a private actor, should there be responsibility placed on the state? And how would the insurance industry think about reforming those rules for those type of torts?
Do you want me to go first? I mean, there's a lot of talk around state-sponsored activity. Is it insurable? I think there's a big difference between, there's a boundary where things become uninsurable. I mean, obviously, a lot of cyber attacks are, let's just say, state-aligned. There's been a lot of work, when we're thinking about from the insurance language, there's been a lot of work historically because people try to rely on war exclusions, which, their definitions of being quite kinetic. The kind of the Lloyd's mandate of recent was not handled badly, but I think that people read the headlines wrong. Really, what they're trying to say is, yeah, if a state actor causes an event, as long as it doesn't breach some kind of threshold, we're okay insuring it. But if it kind of essentially causes a too big an event, then all bets are off. I mean, my personal preference is, could we reach something that almost similar to TRIA, but where the industry loss has to be much, much bigger. TRIA almost disincentivizes risk reward because it just hands it all to the public state just too quickly. But the problem with cyber is there's a potential for very large events. If we're old enough, you might remember the Millennium Bug. Okay, nothing happened, but Millennium Bug's like the nearest thing we've ever had to Cybermageddon, and that there was no intent, there was no maliciousness behind that. So I think we've got a piece where there are events that are almost beyond the scope of what we model is that insurable. We think the remoteness is so far out that I don't see a problem with it. But I think we need clarity. To have a good insurance market, you need clarity to the insurance holder, and the kind of this sort of language that says, the event gets too big in a way that I get to define and I don't get to pay the claim. Yeah. That's a massive disservice. That's the insurance industry doing a bad thing.
I would just add that I don't have a shouldn't on this. I think the bigger issue is going to be around what people are willing to give up. You've got a certain ambiguity in the market right now that both buyers and sellers could use in, post-event settlement discussions. And that means you at least have a chance rather than, having certainty. And look, everybody wants certainty as long as it cuts their way. Personally, I'd throw out the notion of state-sponsored or state responsible because I think it's passé. I mean, you've got, in Russia, for example, the Kremlin creates an environment that favors the domiciling, if you will, of ransomware actors. Is that state responsibility? It strikes me as a stretch. But if you dig deep back into the lit on philosophy of culture, you could probably justify it. Nobody has that much time left, We just don't, and not just on this panel.
Thank you. So look, if you want to follow up the discussion with Tom and Matt, they'll be in the room. But I'm sorry.
Thank you, Quentin.
Time now.
Thank you very much.